Tesla's Q3 2025 earnings reveal a paradox familiar to investors: record revenue growth paired with shrinking profits. On the surface, $28.1 billion in revenue, a 12% year-over-year increase, signals a company continuing to expand its footprint in the EV, energy, and AI-driven robotics sectors. Yet the adjusted net income, falling 29% to $1.77 billion, reminds markets that revenue alone does not guarantee profitability. Investors reacted swiftly, sending Tesla's stock down nearly 5% after hours, highlighting concerns over narrowing margins, rising operational costs, and ambitious capital projects. Elon Musk's comments about his $1 trillion compensation package and his ability to pursue long-term technological visions, including AI and robotics, underscore the tension between shareholder expectations and visionary goals. The upcoming November 6th shareholder vote on Musk's pay package adds another layer of scrutiny. Analysts and industry observers are weighing short-term financial performance against the potential long-term value from Tesla's strategic bets: AI chips, robotaxis, humanoid robots, and energy solutions. Tesla's story is now multidimensional. It is simultaneously an automotive manufacturer, a clean energy company, a robotics pioneer, and a software platform. Each business segment carries its own growth trajectory, cost structure, and investor expectations. Auto revenue continues to dominate, but energy and software segments are increasingly critical to Tesla's valuation narrative. Rising operational costs, U.S. tariffs, and global expansion challenges weigh heavily on margins. Meanwhile, regulatory approvals for full self-driving FSD and robotaxi programs remain key catalysts for future growth. In essence, Q3 2025 is a microcosm of Tesla's broader journey. High revenue growth fueled by global demand and technological ambition, counterbalanced by the reality of capital-intensive innovation and operational complexity. The challenge for Musk and Tesla's management is balancing visionary projects with shareholder patience, particularly when profitability temporarily lags behind narrative-driven expectations. Tesla's Q3 financials underscore a dual narrative: unprecedented revenue expansion paired with disappointing net income. Revenue reached $28.1 billion, up 12% year-over-year, marking an all-time high for the company. This growth reflects continued strong demand for Tesla vehicles, particularly in key markets such as China and the US, as well as growing energy and software revenues. However, adjusted net income fell sharply, down 29% to $1.77 billion. Analysts attribute this decline to several factors: rising operational costs from AI research and development, increased marketing expenses, and supply chain disruptions, including tariffs and component shortages. Investor reaction was swift. Tesla shares dropped nearly 5% in after-hours trading. Musk's colorful commentary, highlighting concerns about shareholder scrutiny affecting his ability to focus on long-term innovation, like building his robot army, illustrates the tension between visionary pursuits and market pressures. The upcoming shareholder vote on Musk's $1 trillion pay package further emphasizes the delicate balance between incentivizing long-term vision and meeting short-term profitability expectations. Investors are faced with the challenge of evaluating whether Tesla's high-growth trajectory and strategic initiatives justify the temporary profit squeeze, and whether Musk's leadership continues to align with shareholder interests. Speaker notes emphasize that Q3 is a turning point, showing Tesla's growth potential and operational challenges. Highlight revenue record versus net income drop, investor reaction, and the implications of Musk's pay vote on strategic initiatives. U.S. EV tax credits played a significant role in driving record deliveries. September marked the final month for the $7,500 federal EV tax credit, which spurred a surge to 497,000 deliveries globally. China's Shanghai Gigafactory led the growth with more than 90,000 units delivered in September alone, demonstrating Tesla's increasing dominance in Asia. Despite these gains, margins remained under pressure. Auto revenue reached $21.2 billion, up 6% year over year, but gross margin slipped to 15.4%, reflecting higher production costs and supply chain headwinds. Operating expenses soared 50% to $3.4 billion, driven largely by AI and R&D investments in full self-driving, Optimus humanoid robots, and upcoming AI 5 chip projects. U.S. tariffs contributed an additional $400 million in costs, highlighting Tesla's exposure to international trade policies and geopolitical risks. This juxtaposition, strong top-line growth versus margin compression, underscores the operational complexity of Tesla's business model. While tax credits incentivize short-term consumer purchases, they also create temporary distortions in revenue recognition and margin calculations. For investors, understanding how temporary incentives interact with long-term operational efficiency is critical for forecasting sustainable profitability. Speaker notes: focus on the dual impact of tax credits, short-term sales boost and margin pressure. Explain operational costs and tariffs as key factors in shrinking net income. Illustrate investor tension between high delivery numbers and falling profitability. Tesla's energy generation and storage division continues to outperform expectations. Q3 revenue for this segment jumped 44% year over year to $3.42 billion, with installed storage capacity reaching 12.5 gigawatt hours, setting a record for the 13th consecutive quarter. This growth highlights Tesla's ability to diversify revenue streams beyond automotive sales. Free cash flow for the quarter surged 46% to $3.99 billion, exceeding market expectations. Tesla now holds $41.6 billion in cash and investments, providing substantial liquidity to fund ambitious projects such as AI research, robotaxi deployment, and global expansion. The energy segment not only stabilizes overall revenue, but also positions Tesla as a major player in the renewable energy and storage markets, aligning with global sustainability trends. Speaker notes: highlight the energy division as a bright spot in an otherwise mixed earnings report. Emphasize the impact on free cash flow and long-term strategic flexibility. Link energy success to Tesla's broader vision for sustainability and technology integration. Tesla is aggressively pursuing AI-driven initiatives. The AI 5 chip, co-developed with TSMC and Samsung, enhances Tesla's FSD capabilities without replacing NVIDIA GPUs, illustrating a dual-strategy approach to AI hardware. Cybercab robotaxi production is scheduled to start in Q2 2026, with pilot programs in 8 to 10 U.S. cities by year-end. Optimus Gen 3 humanoid robots are slated for debut next year, with a long-term goal of producing 1 million units annually by 2030. Musk emphasizes caution, noting that any high-profile accidents could have significant reputational impact, particularly for AI and robotics initiatives. The focus on AI hardware, autonomous vehicles, and humanoid robots signals Tesla's ambition to redefine transportation and labor automation over the next decade. These projects are capital-intensive and carry execution risks, but they are central to Tesla's narrative of technological leadership. Speaker notes: emphasize Musk's long-term vision and risk management philosophy. Connect AI chips, Robotaxi, and Optimus to the overarching strategy of integrating hardware, software, and autonomous technology. Explain why these initiatives may temporarily depress profits but aim to create significant future value. Tesla's regulatory and strategic focus remains global. FSD version 14.1 rollout marks the largest autonomy update in a year, and the company is actively collaborating with regulators in China, the EU, Middle East, and Africa for approvals. Musk believes that FSD and robotaxi deployment will transform transportation and generate substantial long-term value. Yet the disconnect between narrative and profit persists. Despite record revenue and strong energy division performance, margins are compressed, leading to investor frustration. Analysts are split. Bulls argue that FSD and robotaxi adoption could add over $1 trillion in market value, while bears counter that the narrative is strong, but profits are insufficient to justify current valuations. Speaker notes discuss regulatory engagement and market expansion, particularly in China, as critical for Tesla's growth. Highlight the invested tension between ambitious AI and robotics narratives and current profit performance. Conclude by framing Tesla as a company at the intersection of high ambition and short-term financial scrutiny.